The market's got a lot to take down. Why do we think there may be a weakening, well, not of demand, but an expectation of higher yields that may be necessary to make it work?
Yeah, well, first of all, I mean, we saw that to a small degree. Again, the auction, there was no risk that this would be a failed auction.
Yep.
We hear again and again there's this lack of safe haven assets. So, of course, when a big auction comes to market, foreign buyers are going to step in. People are going to buy this. But the question is not, are people going to step into the auction? It's how much are they going to demand? And we did see yields about the highest since 2007. The bid to cover ratio, a sign of demand, is around the lowest since November. So there is a concern here that more supply out there in the market, it doesn't necessarily affect yields right away. But when you also have hedging costs so high, especially for European investors, you need that yield to look attractive to want to come in and buy it.
Didn't we see just a couple of days ago at an auction the worst bid to cover ratio since 2009? I mean, isn't there at least some evidence out there that all this issuance is going to be a little bit much for the current demand?
Yeah, I mean, the thing you have to think about is the long-term trend here. Again, usually one day of bond issuance, there's so many other factors. Maybe around the auction yields will move. But, you know, when you have a day like CPI, of course, that's going to affect yields more so than the issuance. But we have seen this longer trend of the bid to cover ratio, rather, trending downwards, of demand looking a bit auspicious. And in terms of the health of debt markets overall, it is a bit of a strange time. I mean, especially when you look at the yields on bills, on short-term bills coming up. I actually brought this chart with me. So if you think about short-term risk-free asset yields moving upwards, for buyers to step in and get those, one of the arguments for investment grade especially has been negative yields around the globe, low rates in general. But look at that spread. I mean, that's starting to change. Investment grade investors might move back into risk-free assets if they can get the yield they want. And this is something we've been looking at. Investment grade spreads have started to widen. An auspicious time for a little bit of unease about where yields are going on treasuries and bills.
Danny, one of the things I love about your reporting is you dig through the data and look for historical anomalies. How often have we seen, you know, the Fed in this kind of raising stance at the same time as the U.S. needs to increase its borrowing?
Yeah, I mean, if you just kind of think about it from a big macro point of view, it's pretty odd because usually when the government deficit is ballooning and they're needing to borrow more, it's in times where the economy needs that boost. So typically it won't be during a cycle where the Fed is raising rates. But here we indeed do have that, the Fed raising rates, this ballooning deficit. And when you talk to bond bears, one of their biggest arguments for why yields are going to go higher is this market dynamic where we have the Fed unwinding the balance sheet. So that part of the demand equation is not there. Meanwhile, supply is getting larger. So the auctions, of course, are just a small part of the overall picture, but it really does help to back up this idea that a bond bear market is approaching, or in the eyes of some investors is already here.
Already here, Bilal?
I think it is. I think it's, you know, we hit a low in bond yields a number of years ago. It's sort of trending up. It's choppy at the moment, but, you know, we're reaching higher highs and higher lows. Yep. And I think the dynamics overall is the Fed's going to continue to hike rates. That's going to push the entire yield curve higher. We have this sort of shift in supply-demand dynamics. You know, the Fed's pulling back as well. So all the things that were holding yields lower are all turning around now.
Are we underestimating the effect that the balance sheet is going to have? As you say, it's beginning to becomes a little bit more of a kind of more obvious story over the next few weeks. But we've never done this before. It's huge, and in some ways, kind of it's very hard to fully get your arms around and understand.
Yeah, no, I'd agree. I mean, when the Fed announced that they were going to reduce the balance sheet sometime last year, that was a period where inflation was very low. So the market could kind of ignore the supply-demand dynamics and just focus on inflation. Now, inflation has started to pick up. So I think this is the time where the market will kind of be forced to wake up and realize the implications of Fed balance sheet reduction.
Do I just drop duration and just go to the front end? Like, is that the most obvious thing to do right now?
I think so, yeah. I mean, I think it's unwise to be too long duration, so it makes sense to go, closer to the front end. And depending on your view on risk appetite, one could just focus on equity, say, if you want to sort of use, the market in a sort of a more favourable way. Otherwise, just being closer to the front end, long cash makes some sense.